Hello students, welcome to the lecture series on international business. Today we will discuss the balance of payment account and this is part 1. I am Professor Soma Sen Gupta, Kamala Nehru College, University of Delhi. In this lecture we are going to discuss the following topics: meaning of balance of payment account or BOPA, difference between balance of payment and balance of trade, importance of balance of payment account and components of balance of payment account. We will begin with the meaning of balance of payment account. Now, it is a statement that summarizes the country's economic transactions with other countries of the world during a specific time period. So, all exports and imports, including export and import of goods and services, all are included in this balance of payment account and it is for a specific time period. According to Reserve Bank of India, it states that balance of payment account is a statistical statement that systematically summarizes for a specific time period the economic transactions of an economy with the rest of the world. So, what we can understand from this definition is it is related to a time period, it is a summary statement and it records all economic transactions between people or government or companies of your country with the other countries or rest of the world. According to International Monetary Fund (IMF), which describes it as the balance of payment is a statistical statement for a given period showing transactions in goods and services and income between an economy and the rest of the world. Secondly, it includes changes of ownership and other changes in that country's monetary gold, special drawing rights and claims on the liabilities to the rest of the world. Third thing is unrequited transfers and counterparty entries that are needed to balance in the accounting sense any entries for the foregoing transactions and changes which are not mutually offsetting. So, unrequited transfers for which you are not going to get anything in the form of or you are not giving anything, that is also part of balance of payment account like donations, gifts and also if you are taking a loan to balance the payment account, balance of payment account, then it is also a part of this BOP account. Another definition was given by V. Sharan. Balance of payment is a macro level statement showing inflow and outflow of foreign exchange. So, from this definition what you can understand, it includes two types of flow of foreign exchange. One is inflow of foreign exchange and the second one is outflow of foreign exchange. According to Yun and Resnick, balance of payment is the statistical record of a country's international transactions over a certain period of time presented in the form of double entry bookkeeping. So, they are also talking about all those international transactions, recording of that for a certain period, but the specific characteristic which is embedded in this definition is that BOP works in a double entry bookkeeping manner. In general terms, it is a statement that records the flow of foreign exchange arising as a result of international economic transactions. International economic transactions in and out of country include many things. First is export and import of goods and services. Secondly, unilateral transfers like foreign direct investment, foreign portfolio investment. So, all these are part of balance of payment account. Balance of payment statement has a time dimension That is, it is prepared over a certain time period, which can be a quarter, a year, etc. So, it may be for a particular duration, which might not be a particular year, but it may be a quarter, or it may be a year also. But nevertheless, there is a time dimension, or BOP account is related to a specific time period. Flows in balance of payment account. We talked about inflows and outflows of foreign exchange in balance of payment account that we are going to discuss now. Balance of payment is a statement showing inflow and outflow of foreign currency in a country. All receipts from foreigners will be recorded as credit bearing a positive sign. So, all receipts in the form of when you are exporting something to the other country, or you are getting any kind of remittances, then it will improve your foreign currency situation, because foreign currency is coming in. So, it is shown as a credit and it shows a positive sign. So, bears a positive sign. So, the receipts accrue from, as I said, exports like sale of goods and services abroad, resulting in inflow of foreign exchange into the country, or it may be due to sale of any financial asset or a real asset or estate that will also generate receipt, and it will be shown on the credit side or the positive side of the balance of payment account. All payments to foreigners will be recorded as debit bearing a negative sign, including the or indicating the outflow of foreign exchange. So, it means that when you are importing something from outside the country, so you are making a payment to the foreigners, and that will reduce your foreign currency. So, hence it is shown as a negative sign as well as recorded as a debit. Payment in the form of foreign exchange arises due to import of goods and services, as I said, and another is purchase of financial assets or real assets or estates. So, in all these transactions, the foreign currency will be going out of your country, and that's why it is shown as a negative sign. So, if we can summarize what we have discussed regarding the flows in balance of payment, we can say one flow is inflow of foreign exchange, and it will bear a positive entry or shown as a positive entry or credit. And the second is outflow of foreign exchange, and it is a negative entry and is shown in BOP account as debit. Now, coming to the characteristics of balance of payment. We have discussed many definitions of balance of payment, and the characteristics are embedded in those definitions only. So, we will discuss those characteristics one by one. First is summary statement. So, BOP account is a summary statement. It is a summary prepared according to the double entry system of accounting. So, when we talk about double entry, there are two sides, debit and the credit sides, and we have to balance both the sides. So, this is a summary statement. Second is economic transactions. It means it records only the economic transactions. Transactions involving receipts and on account of exports of goods and services is one thing, and the payments on account of import of goods and services, that is also another economic transaction. So, first we will discuss the receipts on account of exports. So, it may be due to exports, it may be capital received by residents also, that will be a kind of an inflow. Then payments can also happen, economic transaction, it is in the form of imports of goods and services. So, you have to make payment. So, it is outflow. Capital transfer to non-resident foreigners will also be considered as outflow. So, all these are measured in some monetary term, or there is any money equivalent value, and that is why these are economic transactions. Income on investment remitted abroad or received from abroad is also part of economic transaction. So, if you are getting an interest or dividend on your investment outside the country, or you have to pay in interest and dividend for to the foreigner who is investing in your country, both of them are economic transactions. Increase or decrease in the international reserves of the country is also an economic transaction. Now, another characteristic is that it is a transaction between a country with the rest of the world. So, any individual, corporate or the government of one country, when it is entering into an economic transaction with anyone outside, whether it an individual or corporate or a government of another country or any other country, then we call it a that is recorded in the balance of payment account. So, transactions between the residents of same country are not included. So, if domestic trade is happening, we do not record it in the balance of payment account. Increase in a country's monetary gold and foreign assets exchange between residents may be included in the balance of payment account. So, even if the transaction is happening between the residents, but it is related to some foreign asset or foreign exchange, then it can be recorded in balance of payment account. It is a flow statement. As we have discussed that there are two types of flows, inflow and outflow of foreign exchange. So, it is a kind of a funds flow statement. It is a compilation of the flow of economic transaction. It is not a statement of the position on a particular date, and it is more like a funds flow statement. Next characteristic is definite time period. So, it covers a specific time period, usually 1 year, and it may be prepared for shorter time period, as we said that it may be for 6 months or for even a quarter, depending upon a country's requirement. But nevertheless, there is always a definite time period, and that is consistently followed in that country, whether it is for a year or 6 monthly or quarterly. Double entry system is another characteristic. We said that there will be equal debit and credit. So, each transaction results in a debit entry and a credit entry of equal account or amount, and that is why it is known as double entry system. BOP account must always balance. So, debit should always be equal to credit, and if in any particular portion, if there is a surplus or deficit, accordingly we take a loan or give a loan and we balance it out. Hence, debit should be equal to credits. Balancing item errors and omissions is added to the balance of payment account. Now, there is a difference between the two terms balance of trade BOT and balance of payment, that is BOP. Let us discuss the difference between BOT and BOP. So, the first is that BOT is a narrow concept in comparison to BOP, and whatever is happening in BOT is actually recorded in BOP as well, but whatever is there in BOP is not recorded in BOT. So, BOT is a narrower concept and BOP is a wider concept and includes BOT. What is covered in BOT then? BOT covers only the transactions arising out of the exports and imports of visible items, that is goods. So, BOT is recording the transactions that are related to goods, physical goods from one country to another. BOT is the difference between the monetary value of a nation's exports and imports of goods over a certain time period. And it does not include the exports and imports of invisible item, that is services like banking, insurance, etc., which is there in case of balance of payment. So, balance of payment takes into account the export and import of both visibles and invisibles like goods as well as services. So, that is why we say that BOP is a broader concept in comparison to BOT. And that is another point. So, we have defined the two terms in the first point of difference, and now we are repeating it when we are talking about the scope of balance of payment. We said that the BOP is a wider concept and BOT is a narrower concept. So, BOP presents a comprehensive account of economic and financial transactions of a country with the rest of the world, and so we will discuss further that it includes goods as well as services exported and imported out of a country. So, now what is the net effect then? The net effect of BOT, that is balance of trade, can be either positive, negative or 0. So, when we are only considering import and export of goods, so it can take the position of positive, negative or 0. It means that when it balances well, that your exports are equal to imports, then there will be 0 BOT. If exports are more than the imports, then it will be positive or surplus BOT, and if the reverse is there, that is your imports are more than the exports, then negative BOT will be there. But in case of BOP, the net effect of BOP is always 0, because we balance out the both the sides, and we will discuss that over the period of time. The another difference between BOT and BOP is capital transfers. Capital transfers are not included in BOT, but capital transfers are included in BOP. So, any kind of sale of your financial assets or real estate, that is also included in BOP. There is a fundamental difference between the two. BOT is the difference that is obtained from the export and import of goods. BOP is the difference between the inflow and outflow of foreign exchange. So, BOP is talking about inflow and outflow of foreign exchange, whether it is in terms of goods or services or factor income or payments. Now, if we talk about with what it deals with, then it is very clear that BOT deals with the net profit or loss that a country incurs from the import and export of goods. But BOP deals with proper accounting of the transactions conducted by the nation with the rest of the world, and it includes all kind of inflows and outflows. If we talk about balancing, BOT can be favorable or unfavorable. As I said, that it can be positive, negative or even 0, that is balanced, well balanced, which is rarely possible. But BOP is always balanced, or it always balances itself. So, that is the difference between BOT and BOP. If we talk about the formulae, there is a difference, like in case of BOT, you will find net earning on export minus net payment for imports, that is BOT, that is all export or export of goods, and the payment because of import of goods. If we find out the difference, then it is BOT. But when we talk about BOP, it is current account plus capital account plus or minus balancing item, which is the errors and omissions, and this we will see over the course of our discussion. Then another point of difference is what factors are affecting BOT and BOP. So, when we talk about BOT, the main factors which affect BOT are cost of production, because it is related to goods. Then availability of raw material, this is another factor which will affect the prices of the goods. Then exchange rate, because we are selling or buying the goods, and for that we have to pay in or we have to know the conversion rate, and that is the exchange rate. Prices of goods manufactured at home. So, when you are whatever you are manufacturing, what is the total price of that goods which you are offering to the foreign buyers. When we talk about factors affecting BOP, then one is condition of foreign lenders. So, whether they are giving you loans or not, that will affect your balance of payment. Economic policy of the government. So, how attuned is government towards the external trade in terms of how much it is allowing that that will have an impact on balance of payment. Or if it is boosting exports, then the BOP will be positive. If it is not restricting the imports, then BOP will dwindle or reduce. Also, the factors we have discussed under BOT, that is the cost of production and the price of the goods, all these factors are also integral part of factors which are affecting balance of payment. So, those factors will affect not only balance of trade, but it will affect the balance of payment as well. Now, coming to the importance of balance of payment, we see that it is a summary statement. So, BOP records all the transactions that create demand for and supply of a currency. So, looking at the BOP figures, you can understand the financial health of an economy or a country. So, it judges the economic and financial status of a country in the short term. BOP may confirm trend in economies, international trade and exchange rate of the currency. This may also indicate change or reversal in the trend. So, whether it is going positive or negative, that you can understand from the analysis of the BOP account. And lastly, this may indicate policy shift of the monetary authority or RBI of the country. So, RBI will make certain monetary policy decisions on the basis of BOP account over the years, so that it can increase the inflow of foreign currency or restrict the outflow of foreign currency. Now, the last part of the first lecture is components of balance of payment. We will give a brief idea of components here and we will discuss them in detail in our next lecture. So, the BOP statement covers and records all types of international economic transactions that a country engages in over a certain period or time period. Based on the type of transactions, the BOP sub-accounts are as follows. It may be current, one portion is current account, the another second portion is capital account, third is unilateral payments or account, then comes the statistical errors and discrepancies, and the last component is official reserves or assets account. This is the looks of or a statement BOP account of BOP account, and you will find all the elements over there or components over there. There is a credit side, there is a debit side. Credit side shows the receipts and debit side shows the payments. So, we have current assets, then in current asset current account you have goods, services and transfer payments on both the sides, that is receipts and payments. Then there is a capital account after current account. In capital account we show the borrowings from foreign currencies or lending to foreign countries on the payment side, on the receipt side it is borrowing. Then a direct investment by foreign countries, that will be in the receipt side. In the payment side it is direct investment in foreign countries. Then comes official settlement account, and here we see that the income in foreign official holdings is on the positive side, and in the negative side increase in official reserve or gold and foreign currencies. Also, we take care of the errors and omissions which may happen while preparing the balance of payment account. So, we will discuss firstly the current account. So, when we talk about current account, the current account shows flows of goods and services, primary income and secondary income between residents and non-residents. So, it is a record of the export and import of goods and services. So, as we say in BOP, goods, services, both the things are there. So, first is it is goods, they are the physical in nature, they include produced items which are owned by individuals or institutions. The section of BOP is a record of export and import of tangible goods. This section records it. The difference between the export and import of goods is known as balance of trade, that we have already discussed, and the formula for that is BOT is equal to export of goods minus import of goods. Then the second item is services. Services, as you know, it is intangible or invisible in nature. For example, travel services, financial services, legal services or consultancy services. Then we also include in current account primary income, which includes amounts payable and receivable in return for providing temporary use of another entity. Example, use of building, labor, finance. So, in a way, the factor payments or factor income that is included here. This consists of receipts and payments made to non-resident in the form of wages, salaries, interest, dividends, etc. And another portion of a current account is the secondary income or unilateral transfers. Secondary income shows unilateral transfers of real resources. This is basically redistribution of income. So, resources for current purposes are provided by one party without anything of economic value being given back as direct return. So, that's why it is unilateral or unrequited transfer. So, let us summarize this lecture. BOP or balance of payment is a statement that summarizes the country's economic transactions with other countries of the world during a specific time period. It is a statement showing inflow, that is positive or credit entry, and outflow, that is negative or debit entry in the BOP account of foreign currency in a country. The characteristics of BOP account are that it is a summary and flow statement involving economic transactions between a country with rest of the world with a definite time period following the double entry system. BOP is a wider concept than BOT as it takes into account the exports and imports of both visible and invisible items, while BOT covers only the transactions arising out of the exports and imports of visible items or goods. So, BOP is a wider concept and BOT is a narrower concept, and BOP includes BOT. The components of BOP accounts are current account, capital account, unilateral payments account, errors and discrepancies and reserves, or this is also known as official reserve. The current account is a record of the exports and import of goods and services. So, I believe you have understood that. Thank you so much, students.